It's a pretty lovely evening from here in Delhi, and hope that each one of you, as always, are absolutely fine. And we on our part always pray to the Almighty to give you fine shape, keep you always in fine spirit, and of course, shower supreme success upon you. So on such note, we start this particular session. As you can see flashing on your screens, India's 110 corresponding to International Financial Reporting Standard 10, Consolidated Financial Statement, yes, we are talking about. Now, most of us are under an impression and we perceive this chapter to be a dreaded one, but honestly speaking, it's a pretty easy chapter, and once you are thorough with the grounding, and as is the case with any chapter, once we are absolutely thorough with each and every aspect, every nitty and gritty of that particular chapter, then quite obviously later on that particular chapter, howsoever tough it might be, howsoever complex it might be, howsoever tedious it might be, then appears almost a cakewalk for us. So our first target should be to somehow get supreme amount of what we call proficiency in the initial concepts of this particular chapter, and I'm very sure after that you are going to feel very easy regarding this particular chapter, and also you'll feel quite confident to tackle any sort of problem in the examination. Now, as far as India's 110 is concerned, what exactly is the theme of this particular chapter? India's 110 actually sets out some guidelines with respect to an entity having control over the other entity, and the guidelines are with respect to preparation of the consolidated financial statement. Put it in simple words. If I have got control over the other entity, then other entity will be my subsidiary company and I will be known as parent company. Remember one thing, and I have got control over the other entity, then other entity will be my subsidiary company and I will be parent company. In that case, Ind AS will apply, and Ind AS simply states that if you have got control of a particular entity, that when you have a subsidiary, then you are supposed to prepare consolidated financial statement. It is as simple as that. Is it clear to you or not? That means this particular standard will apply only when an entity is having a control over the other entity. Then only Ind AS 110 will apply. Because there may be some chances that I may have to prepare consolidated financial statement, but in that case, Ind AS 110 may not apply, because in that case, I might not be having the control of the other enterprise. Is it clear to you or not? For example, if I have got, let us say 25% stakes in a particular entity, I have invested in 25% of the share capital of another entity. So in that case, other entity will be my associate. It cannot be my subsidiary. So in this case also, I will have to prepare the consolidated financial statement, but in this case, Ind AS 110 will not apply, because here I am not having the control of the other enterprise. If I will have stakes more than 50%, in that case, that entity will be in my control, and in that case, Ind AS 110 will apply. Put it in simple words. When your investments are more than 50% in an entity, quite obviously in that case, the control will be in your hand and other entity will be your subsidiary. In that case, you will have to prepare at the year end. So consolidated financial statement, and at the year end, consolidated financial statement will be prepared in the light of Ind AS 110 when you have got the control over the other enterprise. However, if you have only the significant influence over the other enterprise, significant influence accrues when actually you have investment in the vicinity of 20 to 50%, 20%, 25%, 30%, 50%. Not more than 50%. So if your investment in other entities is in the what we call slab of 20 to 50%, in that case, you are exercising significant influence. You are not exercising control. So other entity cannot be considered as your subsidiary company. In that case also, you will have to prepare the consolidated financial statement. But in that case, consolidated financial statement shall be prepared as per Ind AS 28 and not as per Ind AS 110. So first point, you have to make it very clear. Is it clear to you? And this is the point which I am writing now. So just pay attention down over here. Every entity having every entity having a subsidiary or subsidiaries. You may be having one subsidiary or more than one subsidiary. Every entity having a subsidiary or subsidiaries comma, as per Ind AS 110, as per Ind AS 110, must prepare what? Consolidated Financial Statement, CFS. CFS in this entire chapter will stand for Consolidated Financial Statement. Don't confuse it with cash flow statement. Correct? I told every entity having a subsidiary or subsidiary as per this particular Ind AS shall prepare what we call Consolidated Financial Statement. Is it clear to you? Further, other entity could be our subsidiary. Other entity could be our subsidiary. Now, how can other entity could be our subsidiary? When we have control over that particular entity, other entity could be our subsidiary entity, only when investor has control over the other entity. Correct? Just to make the point clear, suppose there is an entity by the name of E1. This is an entity, and this entity, let us say, has 70% stakes. 70% stakes. When I say 70% stakes, it means out of total share capital of this particular entity, let us say E2, out of total share capital of this particular entity, 70% of the shares are in our hand. Correct? So then we may call it in accounting terminology that we are having 70% stakes in this particular entity. In this case, this entity E1 will be first of all termed as investor, because this entity has invested the amount. This is investor. And obviously this entity in which investment has been made will be termed as investee entity. Now, because when we invested in 70% shares of this particular company, or when we purchased or acquired 70% shares of this particular company, the control of this company will come to our hand because our investment is in excess of 50%. Quite obviously, and you are well aware of this particular point, I need to require to stress upon it unnecessarily. When we have majority stakes means more than 50% stakes in the other entity, then quite obviously it means the control is in our hand. So because in this case, because of our what we call investment, we are exercising the control, we shall be, or should I say E1 will be considered as parent entity. Sometimes we call it holding company also. And investee entity, because investee entity will have to now obey our orders, our instructions, our guidelines. So it will be our subsidiary company. It will be our subsidiary company. So remember one thing, other entity could be your subsidiary only when you are having the control over that particular entity, number one. And if you are having a control over the other entity, then as a parent, you need to prepare the consolidated financial statement. But very important to understand, many people here confuse. When you are going to prepare the consolidated financial statement at the year end, then only Ind AS 110 will apply. For example, suppose I acquired the control let us say for simplicity's sake, in the beginning of the year. If I am going to prepare consolidated financial statement in the beginning of the year, in that case, Ind AS 103 will apply. Correct? On the date of acquisition, we do the accounting as per Ind AS 103. In that case, consolidated financial statement will be prepared as per Ind AS 103. But by the end of the year, when we reach the end of the year and in the subsequent years, then we are going to apply Ind AS 110. That means Ind AS 110 will apply only if you are having a control over the other enterprise, and at the subsequent date, that means after having taken control, when you will reach the what we call financial reporting date, in that case, when you are going to prepare the consolidated financial statement, then you are going to actually apply Ind AS 110. I have already, just to clear the doubt, I have already now talked about this particular fact. It's sometimes what happens, we make the investment. Let us say I have invested in 30% stakes of the other entity. I have 30% stakes of the other entity. In that case, I am not having the control, although I am having the significant influence. In that case, other entity will be considered not as my subsidiary. Other entity will be known as my associate. Even in that case, I will have to prepare the consolidated financial statement. But in that case, consolidated financial statement will be prepared in the light of Ind AS 28 and not as per Ind AS 110. Ind AS 110 will apply only when you are having control of the other enterprise. So now I am not going to repeat this particular point. So very important, when we have the control of the other enterprise, then only we are supposed to prepare the consolidated financial statement, number one. Now the question is actually how you can acquire the control. I have already told you 99.99% control accrues to us actually on account of our investments. And if our investment is of such magnitude that it brings us more than what we call 50% voting rights of the other entity, in that case, quite obviously, we may say that we are exercising the control. But sometimes control can also be what we call taken of the other enterprise by mutual agreement. For example, I have invested only in 10%. For example, if I have invested only 10% in 10% shares of other company, that means this time my investment is just about 10%. So 10% will not give me even significant influence, leave alone control. So this time other entity cannot be considered as my associate or my subsidiary. However, let us say there is an explicit agreement between the other entity and our entity, that our entity, that is investor entity, shall have the right to direct the what we call all the relevant activities of the other entity. So even in that case, it will be considered that we are the parent entity, because this time it will be construed as if the control is in our hand. So 99.9999% control generally accrues because of your investment or because of your majority stakes. But on rare occasions, control could accrue to you on account of some agreement between the other entity or because of some agreement between the shareholders. Sometimes shareholders decide that the right of composition of board of director will be in the hands of so and so entity. So if you are having the what we call right to compose the board of directors of the other entity, even in that case, it will be construed, it will be inferred, it will be concluded as if you are having the control. Is it clear to you? So that is exactly the point I am going to write next. Control. Control. Generally, control is exercised when entity has the power, entity has the power to direct all the relevant activities of the other entity. So when I say I'm having the control of the other entity, indirectly what actually I'm saying is that I'm having the power. This word power is very, very powerful. That means actually I'm having the power to direct all the relevant activities. Correct? Next point. power or control. Power is synonymous with control, correct? Power generally accrues. How you acquire such power? Power generally accrues on account of majority stakes in the other entity. As I told you, majority stake means when your investment is of such magnitude that it is fetching you what we call more than 50% voting rights. So quite obviously, in that case, power or control is in your hand. Power generally accrues on account of majority stakes in the other entity. So 99.99% we get power to direct the relevant activities. Indirectly, it means we get the control because of our investment in the other entity. Correct? As I just told you that E1 has invested in E2 and their stakes are 70%. So quite obviously in this case, power is accruing because of investments in the other entity. However, power, whenever I will write power, it means actually control. However, power may accrue on account of right to compose board of director BOD of the other entity. So sometime other entity could be under your control not because of your majority stakes, but because of the fact that you have the right to compose their board of directors. Is it clear to you or not? For example, let me elaborate this particular point. For example, suppose there is an entity and this entity has invested only in 30% stakes. This entity has this time 30% stakes. Let us say this is P1 Limited and this entity has invested in S1 Limited. And out of total share capital, 30% of the capital is in our hand. That means we have 30% stakes in this particular entity. Now, because of our stakes, we are not having the control in this case. However, let us say P1 shall have, let us say there is an agreement between P1 and S1 that P1 shall have the right to compose the board of directors, to compose the board of directors of S1 Limited. Compose the board of directors means we have the power, we have the right to appoint, to reappoint, to set out the remuneration with respect to board of directors. So when we have such right, it is construed as if we are having the right of composition of board of directors. So if we have the right of board of director, even in that case, it will be considered as if S1 is in our control. Correct? Also, power may accrue when investor entity has the right to direct all the relevant activities of investee entity. Investee entity. Now taking the previous example, suppose P1 has invested only in 30% share capital of S1. So logically, as per our investment, we are not having the majority stakes. But let us say there is a specific right between these two entities or between the shareholders of these two entities that P1 shall have the right to direct all the relevant activities. So quite obviously, even in this case, we may say as if control is in our hands. So when we exercise the control of the other entity, then other entity will be considered as our subsidiary. And then at the year end, when we will prepare consolidated financial statement, that consolidated financial statement shall have to be prepared in the light of Ind AS 110. Time and again I am telling, and many people are having confusion regarding that actually. When we acquire the control of the other enterprise, when the date on which we acquire the control, that is known as date of control or date of acquisition. Even in that case, sometime consolidated financial statements are prepared. On the date of acquisition, when we are going to prepare CFS, that will be prepared as per Ind AS 103 and not as per Ind AS 110. Ind AS 110 applies only when you are going to prepare CFS on the reporting date, that is year end as we call it, or simply put on subsequent dates. Subsequent dates means dates which are falling after the dates of acquisition. In that case, Ind AS 110 will apply. But Ind AS 110 will apply only, last time I am repeating, when you are having the control of the other entity, and when you are having the control because of your majority right or because of any other thing. Other entity will be your subsidiary. In that case, at the year end, you will prepare in CFS as per Ind AS 110. Correct? However, if you are having an associate, even in that case, you will have to prepare CFS. But CFS in that case will be prepared as per Ind AS 28. Even if you are having a joint venture, correct? That means other entity is your joint venture, not your subsidiary. Even in that case, you will have to prepare the consolidated financial statement. But in that case, consolidated financial statement will be prepared in the light of what we call Ind AS 28 and not in the light of Ind AS 110. Is it clear to you or not? Sir, is it necessary to prepare consolidated financial statement for all types of parent? As is the case, almost in every standard, there are some exceptions. Even in this standard, there are some exceptions. Sometimes, even if you are a parent and you are exercising control of the other entity, but you may not be required to prepare consolidated financial statements, so it will be called as a case of exception. So there are basically two exceptions, but we shall talk about the exceptions when we will reach at the end of this particular chapter. Is it clear to you? At this moment, I am trying to tell you actually when we are supposed to prepare the consolidated financial statement in the light of Ind AS 110. Number one, after having noted down these points, now you need to understand what are the principles of preparation of the what we call consolidated financial statement. Correct? It may look tough, it appears tough, but it is not tough. Correct? And I will make it absolutely easy and almost, as I keep on telling, like a walk on the park. So if you are going to pay attention, I am very sure you are not going to confront any sort of problem. So here we go, and I will now tell you the next point is, these are the basic points which we talked about, and the next topic is, let me write it with the red pen as I always do. Here is the red pen. So now we are going to talk about steps in preparation of consolidated financial statement. So, steps in preparation of consolidated financial statements. So what are the steps which one need to apply to prepare the consolidated financial statement? Correct? So here I'm going to tell you, just pay attention. For simplicity's sake, I'm writing a sort of demo before you so that you understand it better, and please quickly note it down also. Let us say balance sheet of P Limited and its subsidiary S Limited and its subsidiary. Since I have written word subsidiary, automatically it means P Limited is having control of this entity. Balance sheet of P Limited and its subsidiary S Limited as at 31st of 3, 2023 is as follows. Is as follows. Is as follows. Now this time I am drawing balance sheet of P Limited and S Limited, correct? So first let me write assets. As you know, nowadays all companies that follow Ind AS are supposed to prepare their financial statements as per Division 2 and not as per Division 1. So in Division 1, we write assets first. So there is no point in blinking your eyes. So we write assets first. Let us say, first let me write here non-current asset, NCA, non-current asset. Under the non-current asset, I have written, let us say, property, plant and equipment. We presume property, plant and equipment of P Limited is equal to 10 lakh and of S Limited, subsidiary company, is equal to 5 lakh. Correct? Further, I write here financial assets. Now this is a new heading inserted in Division 2, financial asset. Financial asset is written under non-current assets, number 1. It can also be written under current asset. Correct? So non-current asset, financial asset means generally here we write investments. So write here investments. Investment is considered as financial asset. Investments in 3,000 shares. 3,000 shares of what should I write? Of S Limited. And I am writing in the column of P Limited, and let us say I have written here 10 lakh. What does it mean? It means P Limited has purchased 3,000 shares of S Limited. And in order to acquire 3,000 shares, we paid amount of rupees 10 lakh. It is quite high amount, no doubt about that. Correct? And here I have written nothing. It means S Limited is not having any investments. Then I will write here current assets. Current assets. Under the current asset, I write 6 lakh in the column of P Limited and let us say 9 lakh in the column of S Limited. So total of asset side, let us say, is equal to 26 lakh if I am correct. And total of S Limited is equal to 14 lakhs. I am framing a question to let you know how to prepare the what we call consolidated financial statement. It is always best to understand these steps by way of an example rather than theory. Now, I write here towards the equity and liability side, equity and liability. Equity and liability. Under equity and liability, as you know, first of all, we write equity. What does equity means? Equity means share capital plus reserve and surplus, and reserve and surplus under Division 2 are known as other equity. Reserve and surplus are known as other equity, correct? And I'm not going to actually repeat all these things time and again. As a professional student of this level, you are supposed to have knowledge regarding this. Equity. Under equity, as I told you, we write two items. One is share capital. We presume one share is of 100 each, correct? This is the face value of the share. And total share capital of P Limited, we further presume is equal to 10 lakh and of S Limited is equal to 5 lakhs. This is total share capital. Then I write here other equity. I have already told you other equity stands for reserves and surplus. All type of reserve, general reserve, profit or loss account, security premium, capital reserve, gain on bargain purchase, etc. are written under it. Other equity. Other equity. Correct? and other equity, let us say, is equal to 7 lakh of this entity, and let us say 3 lakh of S Limited. Besides the equity, we write, besides equity, let us say I have written here liabilities. Under the liability, I have written here non-current liability. Let us say non-current liability of P Limited is equal to 4 lakh, and of this entity it is equal to 2 lakh. This entity it is equal to 2 lakh. And besides current liability, and we presume current liability of this entity is equal to 5 lakh, and current liability of this particular entity is 4 lakh. Now if I will total it up, 1721 plus 5, it is 26 lakhs, and 8 plus 2, 10 plus 4, 14. So fortunately totals are matching. This is the balance sheet of S Limited, this is the balance sheet of P Limited, and let us say some additional information is given to you also, additional information. In the additional information, it is given, P Limited acquired shares in S Limited on 1/4/2022. Now balance sheet date is 31st/3/2023. You acquired the control in the beginning of the current financial year, correct? Further, it is also given on 1/4/2022, balance in other equity of S Limited was rupees 1 lakh. You can see here in the column of S Limited, correct, corresponding to other equity, I have written 3 lakh. Other equity, you can presume in your mind, and let us say it is profit and loss account, correct? Because other equity will contain items like profit and loss account, general reserve, etc. Okay, I will write in bracket profit and loss account. Let us say there is only one item in other equity this time, profit and loss account. So 3 lakh is the closing balance, because this is balance sheet as at 31st/3/2023. Now question is also stating that in the beginning of the year, the balance in other equity or profit or loss account of S Limited was 1 lakh. Such type of information will always be given to you in the question. Now the main question actually, and what we are trying to learn out of it, we are trying to learn out of it principles of preparations of consolidated financial statement. So how to prepare the consolidated financial statement. Whenever we are going to prepare consolidated financial statement, I have already told you, consolidated financial statement will always be prepared on subsequent dates and not on subsequent dates as per Ind AS 110. Correct? But consolidated financial statement may be prepared in the beginning of the year or on the date of control, sorry. In that case, Ind AS 103 will apply. Anyway, so on 31st/3/2023, we are going to prepare the consolidated financial statement in it. And of course, we will have to apply the provisions of Ind AS 110. So what are those provisions and what are those guidelines and what we have to do? These are the questions we are trying to unfold through this particular demonstration, you may say so. It is very important whenever you are going to actually prepare the consolidated financial statement, you need to take care of one important aspect. What is the investment of P Limited? What is the investment of parent company in the subsidiary company? That will be given always either in the balance sheet itself, or it may be given to you in additional information. It might be given to you otherwise in additional information, correct? So however, here, and most of the time it will be given this way around only. So this time it is written that P Limited has invested in 3,000 shares, correct? It is also very important that in the next step, after noting down what is the what we call investment of parent limited, then the next step, which we are going to see later on, to note down very carefully the total share capital of S Limited. As you can see here, the total share capital of S Limited happens to be 5 lakh. And since one share is of 100, so we can safely conclude that S Limited, as far as is concerned, is having total number of 5,000 shares. Out of those 5,000 shares, 3,000 shares are in the hands of P Limited. Quite obviously, majority stakes are in our hand. That means we are having more than 50% of the share of this particular entity. So that is why control is in our hand, and that is why this particular entity will be our subsidiary. After noting down these 2 points, your next step should be to take care of the date on which you acquire the control, because ultimately that particular date is going to be very, very critical, because entire solution will revolve around this particular fact, correct? So that is why it is of paramount importance for you to note down the what we call date on which you acquire the control. And it will always be given in the question. You can never ever presume it. But on one rare occasion, you will have to presume this date when no dates will be given in the question, and how we are going to presume that I am going to discuss later on. It is given in the question 99.99%. I have already told you it will always be given. In this question, it is given you acquire the control on 1/4/2022. These are the 3 things basically which you have to take care of, to be very honest with you. Rest of the things will automatically follow. Don't worry about that. So keeping into account these 3 vital pillars of solution, now we start the solution, correct? And we are trying to learn, in fact, what are the steps. Now, step number A always is, step number A, whenever you will start solving the question, step number A will be analysis of accounting period. Analysis of accounting period of S Limited. Although it is not necessary to write, because whatever we are going to do, that will always be in respect of S Limited, that is subsidiary company. What we mean by this particular step and what we are supposed to do under it, try to understand. In order to analyze it and why we are analyzing it, you will come to know in a short while. First of all, stretch a line. Note down both the ends of the accounting year. That means closing and opening date. Now, closing date is given to you as 31st/3/2023. Quite obviously, if closing date happens to be 31st/3/2023, your opening date must be 1/4/2022. Once you have noted down these 2 dates very carefully, the next point which you need to understand and make it a habit, correct, that once you have stressed this line, draw out this way, this arc which I have drawn out, correct, reflecting that this is the accounting period. Sir, even if you would not have drawn this, we would be knowing that this is nothing but accounting period. Yes, you are right, absolutely. But anyway, this is accounting period. Whenever I would say accounting period, it means I am referring to the period starting from the beginning of the current year and ending to the current, and ending on the date of the current year. Is it clear to you? This is accounting period, number 1. Number 2, now actually note down the date of control. Date of control or date of acquisition, whatever you may like to write. Date of control, DOA or DOC, whatever you may like to write. I have a habit of writing DOA, that is date of acquisition. That means date of acquiring the control. In this question, it was very clearly and in a crystal clear manner it was written that we acquired the control in the beginning of the accounting year. After this, again stretch a line. So many lines we have to stretch. Yes, then only you will learn the art of solving the question. Correct? The initial sweatings which you are going to do later on will save you lots of time. Don't worry about that. Remember, one thing is speed gets automatically picked up when your control is very high. But in order to develop the control initially, we shall have to actually sweat it out. So this is the day on which we acquired the control. That means this line which I have drawn reflects the period after the date of control. Correct? This line is simply reflecting the period after the date of control. It is known as period after the date of control or date of acquisition. This period after this date 1/4/2022 till 31st of 3/2023. In fact, this is our accounting period also, because I have just shown you that this is the accounting period. Accounting period simply will show you the range between the opening date and the closing date. Correct? Entire accounting period. So we can say that entire accounting period is period after the date of acquisition. Can we say it? Yes, absolutely, because date of acquisition is 1/4/2022. So entire accounting period we may say is period after the date of acquisition. And in more technical words, later on we will call it post-acquisition period. Post-acquisition period. It will be known as post-acquisition period. Post-acquisition period. It will be known as post-acquisition period. Put it in simple words. In this entire accounting period, correct, all 12 months are related to post period, post acquisition period. That means there is no pre-acquisition period. In fact, what is pre-acquisition period? Pre-acquisition period means period preceding the date of acquisition. Now, in this case, because we have acquired the control on 1/4/2022, so there is no period preceding the date. There is no period in the current period which is preceding the date of acquisition. What my point is, the first date is 1/4/2022 of the current year. Now, period preceding the date of acquisition, then I will reach the past years, isn't it or not? But anyway, so period preceding the date of acquisition, period preceding the date of acquisition is known as pre-acquisition period. It is very important for you to divide the entire accounting period into pre and post. Now the point here is that in this question we can safely say, as far as current accounting period is concerned, entire current accounting period is post-acquisition period and there is no pre-acquisition period in the current accounting period. Correct? In the current accounting period, entire 12 months are post-acquisition period. Why this classification or bifurcation is important, that you will come to know after a while. At this moment, your concentration should be to understand what we are supposed to do. Of course, you need not require to worry. We are going to provide you logic for each and everything. Correct? After having taken care of this step while preparing the consolidated financial statement, now your next step, which is quite vital, is computation of degree of control. Degree of control. Now, what we mean by degree of control? Degree of control. In order to compute degree of control, first of all, take care of number of shares of subsidiary company. Number of shares of subsidiary company S Limited. If I am going to ask you, let me know the total number of shares of subsidiary company. I just told you total share capital of subsidiary company is rupees 5 lakh, and one share is of 100. So quite obviously number of shares 5,000. Correct? Out of those 5,000 shares, how many shares are held by investor entity, that is parent entity? Held by P Limited. Held by P Limited. We have just seen that out of 5,000, 3,000 shares are in our hand. And out of 5,000 shares, 2,000 shares are not in our hand. Correct? Held by P Limited. That means this entity S Limited, try to understand these points. Initially, you might be feeling I am taking lot of time. It is very important to show your patience. Let me take a rough sheet here so that I can explain you better. I have taken, just allow me 2 minutes. Yes, these are the rough sheets now. Let me explain some vital points before you understand. This is S Limited, and total number of shares of S Limited 5,000. Out of those 5,000, 3,000 shares are in the hands of P Limited, and 2,000 shares are not in hands of P Limited. For simplicity, we will call it other shareholders. Other shareholders. Now look carefully. From the perspective of S Limited, we may say entire share capital is in the hands of only two parties. One, P Limited, who is having 3,000 shares, and other shareholders, second party is other shareholder, who are holding down 2,000 shares. It is as simple as that. These other shareholders are known as non-controlling interest holder. Earlier we used to call them minorities. Earlier, we used to call them minorities under existing accounting standard AS 21. But now we call them NCI. Other shareholders are known as non-controlling interest holder. Why? Try to pay attention. Because they are shareholders of this company, you are not having any doubt in it? Yes, sir. If you are a shareholder of an entity, quite obviously that means you have some share, you have some interest in that particular company. Correct? Obviously, when I am going to invest into a particular entity, I will acquire in proportion to my share right over the net assets of that particular company. So because other shareholders have also invested in this entity, put it in simple words, out of 5,000, 3,000 shares are in our hands. So we may say 3/5 control or 60% control is in the hands of P Limited. And other shareholders in all are having 2,000 shares. So that is 2/5 control they are also having over this particular entity. When we say they are having 3/5 stakes in this entity and they are having 2/5 stakes in this entity, what we mean by that? It means whatever net assets of this entity S Limited are there, out of that 3/5 now belong to P Limited and 2/5 belong to the other party, that is other shareholders. Now I was trying to tell you they are known as non-controlling interest holder. Why they are known as non-controlling interest holder? You need to understand that. They are known as non-controlling interest holders simply because of the fact that they are having some interest, but they are not controlling this entity. Non-controlling interest holder. Non-controlling interest holder means they are interest holder, but they are not in the control of this entity. While we means P Limited, we are controlling interest holder. Is it clear to you? Because we are having the control over this particular enterprise, because we are having 60% share or 3/5 control of this particular entity. Is it clear to you or not? Correct? So we have to find out degree of control. Another important facet is that you must understand this, because entire chapter will look so easy once you are going to actually put a little bit of time over here. So pay attention. When I say degree of control, as in this case I told you 3/5 control is exercised by P Limited and 2/5 control is exercised by other shareholders, that is non-controlling interest holder. Correct? So I just told you, what does this 3/5 and 2/5 signifies? It signifies that whatever net assets of S Limited, subsidiary limited, whatever net assets of subsidiary limited are there, out of those net assets, 3/5 actually belong to P Limited and 2/5 belong to actually NCI Limited. Is it clear to you? Now I will explain it actually to my satisfaction further. Just forget about this entity. Suppose there is an entity, for simplicity's sake I am using the T form. Suppose there is an entity by the name of Q Limited. Correct? And let us say this entity has fixed asset or property, plant and leave it. Non-current asset worth rupees 10 lakh. Non-current asset worth rupees 10 lakh. Correct? Further, this entity is having current asset, let us say, to the extent of 10 lakh. Besides, this entity is having liabilities to the extent of, let us say, 5 lakh. To the extent of 5 lakh. And equity share capital of this entity is 10 lakh. And reserve and surplus of rupees 5 lakh. Remember one thing, reserves is also known as other equity because it is part of other equity, reserves, profit or loss account, etc. Let us say in this entity, 80% stakes are in the hands of P Limited. This is balance sheet of Q Limited. And P Limited has 80% stakes in it. It means 20% stakes are in the hands of other shareholders, that is non-controlling interest holder. That means 4/5 is the control of P Limited and 1/5 is the control of NCI in this particular entity. When we say we have control over this particular entity, what does it mean? Just pay attention. Suppose I am going to ask you, please let me know the net assets of this particular entity. And within a flick of second, you will calculate it. Sir, current asset, non-current asset 10 lakh, current asset 10 lakh. So total asset is equal to 20 lakh and liability is equal to 5 lakh. So net assets must be equal to 15 lakh. Absolutely. Out of this 15 lakh, 80% will belong to P Limited and non-controlling interest holder will have right over 20%. That means out of 15 lakh, I will say 3 lakh worth of asset belong to other shareholder because they have also interest in this entity, and 12 lakh worth of asset will belong to P Limited. That is what we mean by degree of control. Remember one thing. Net asset is also known as equity. Net assets is also called as equity. Net assets can be computed by subtracting from assets liabilities as we did. However, net assets can also be found out this way. Share capital plus other equity. Share capital plus other equity. Because net assets means equity. And equity means share capital plus other equity. This you need to understand in the beginning itself. If I want to compute my share of net assets in this particular entity, either of these two approach I can adopt. Correct? One approach looks very simple, but unfortunately we may not be able to use it time and again in the upcoming questions. Correct? So that is why you will have to focus over here. But anyway, net assets can be found out by subtracting liability from assets. Net assets can also be found out simply by adding share capital and other equity. For example, in this case, if I add share capital 10 lakh and other equity, that is reserve, so straight away I can get 15 lakhs. So first of all, you need to understand that net assets and equity are one and same thing. Correct? Number one, net assets means actually assets minus liability, and equity means share capital plus other equity, but both these things will always remain same. So when we say we have so much of stakes in the other entity, indirectly we are saying that we have got so much of stakes in the equity of that particular entity. So much of stakes in the equity indirectly means so much of stakes in the net assets of that particular entity. I hope now it is clear to you. So next step is computation of degree of control. So why we compute degree of control, that I hope you must have got a bit of idea regarding the same. But anyway, so such shares of subsidiary which are not in our hands, I have already told you, not held by P Limited are 2000, and these 2000 shares holders group will be called as non-controlling interest holder. So we may say that 3/5 control is in our hand and 2/5 control is of non-controlling interest holder. But what we mean by control here in real sense, that means we are controlling the 3/5 of the equity of the subsidiary, and other shareholders are controlling 2/5 of the equity of the subsidiary company. This is the important point which you need to understand. After done away with this particular step, Now the next step is analysis of, third step is step number C, analysis of other equity, analysis of other equity, analysis of other equity of, analysis of other equity of S Limited. Other equity means you are simply analyzing the other equity items of S Limited. Now in this case, in the question which I have written before you, where is the question? Here I have written other equity 3 lakh. And we are presuming there is one item in other equity, that is profit and loss account, 3 lakh. Correct? What we mean by analysis of other equity? See here. (31st 3/2023), 1/4/2022. On this date, balance in other equity of subsidiary company is 3 lakh. At the end of the year, total balance in profit and loss account or other equity of subsidiary company is 3 lakhs. However, it was given to us under the additional information on 1/4/2022, balance in other equity of S Limited was 1 lakhs. That means in the beginning, balance in other equity of S Limited was 1 lakh. Quite obviously, this 1 lakh were not earned in the current year because this is the opening balance. If this is the opening balance, it means this was the closing balance at the end of the last year. And that balance is brought forward. Is it clear to you? Opening balance is nothing but balance brought forward of last year. So that means this profit was earned in the last year itself. Now, very important for you, first of all, you compare both these profit. Obviously, you will come to know that if opening balance is 1 lakh and at the end of the balance sheet we are reflecting other equity at 3 lakh, it means we have earned a profit of rupees 2 lakh in the current accounting cycle. That means in the current accounting period, that means from 1/4/2022 till 31st of 3/2023, we have earned rupees 2 lakh worth of profit. Rupees 2 lakh worth of profit. Is it clear to you? We will see in the upcoming question that this 2 lakh worth of profit which you have earned, you means subsidiary company has earned in the current accounting period. This profit will have to be bifurcated into pre and post acquisition period. If I am going to ask you a very simple question, could you let me know how much of this profit was earned from 1/4/2022 to 31st 3/2023. That means in the entire accounting period, we earned a profit of 2 lakh. Subsidiary company earned a profit of 2 lakh. Out of this profit, what portion was earned in the post-acquisition period? Could you let me know in this particular case? So 2 lakh. Good. Because this current accounting period is entirely post-acquisition period as we did the analysis under the first step. 1/4/2022 is also the date of control. That means these 2 lakhs were earned after the date of control. So that is why this entire 2 lakh will be considered as post-acquisition profit. That means out of 2 lakh, there is nothing which can be termed as pre-acquisition profit. Are you getting my point or not? Because entire accounting period is post-acquisition period. So that is why whatever profits which subsidiary company has earned in the current accounting cycle shall be termed as post-acquisition profit, and nothing out of this can be termed as earned in the pre-acquisition period. Is it clear to you or not? However, this 1 lakh were earned in the last year itself. Are you getting my point or not? So this 1 lakh will be considered as profit earned in the last year, means pre-acquisition profit. Opening balance 1 lakh, because this 1 lakh was earned when this entity was not our subsidiary company. That means before the what we call date of acquisition, these 1 lakhs were earned. So these 1 lakh worth of profit, that is opening balance, will always be considered as pre-acquisition profit. Is it clear to you? Later on we will see that post-acquisition profit, sometimes people also call them as revenue profit. Reason being is that these profits were earned because of our indulgence in the post-acquisition period. That means this company has now become our subsidiary company and we were directing the company. That means we were playing a role in earning of these profits. So that is why these profits are termed as revenue nature profits. Although this sort of classification is not needed nowadays, but just to actually make the point clear. And whatever profits which were earned prior to the date of control are known as capital profits or pre-acquisition profits. That means pre-acquisition profits are also known as capital nature profit. Capital nature profit, and these profit in this case are also of capital nature profit because these profits were earned in the last year. Correct? So that is how we will have to do the what we call analysis of other equity of S Limited. But why we are doing that, immediately now you will come to know. The next step while preparing consolidated financial statement is D, analysis table. Analysis table. Why we are preparing this analysis table, you will come to know immediately about that. Just a little bit of patience is needed. P Limited, and here I have written NCI. Entire share capital of subsidiary companies in the hands of P Limited, or entire control is in the hands of P Limited and non-controlling interest holder, but they are having the control of the subsidiary company. Correct? First of all, when you prepare analysis table, correct, you will always write here share capital of S Limited. Share capital of S Limited. You will always write share capital of S Limited. Actually, why I'm interested in preparing analysis table, we will see later on that because of some or other reason, we are interested in finding out the equity of S on the date of acquisition. We are interested, we means parent. Parent is interested in finding out equity. Equity means share capital plus other equity. Equity of subsidiary company on the date of acquisition. Now you let me know, I am going to ask you a very simple question. Very simple question. I hope you should be in a position to give me the answer. Closing date is 31st/3/23. Opening date is 1/4/2023. And share capital of S Limited on this date is 5 lakh. Correct? I'm asking you on the date of acquisition, because date of acquisition is 1/4/2023. That is beginning date. This is date of acquisition. I am interested in knowing what was the amount of share capital of S Limited on this date. Could you tell me? Share capital is given to us on this date. I am interested in knowing the amount of share capital on this date. Could you let me know actually what would have been the amount over there? So 5 lakh only. Good. Because share capital will always remain same throughout the year, unless and until we are given information like this that we have issued fresh share, and it will never ever be given in the question. Is it clear to you? So whatever closing balance is there, without an iota of doubt, we can easily conclude that this must have been the balance in the share capital even on this particular date. It is as simple as that, because day in, day out, no company issues shares. Is it clear to you or not? So that is the reason, whatever closing balance is there in the share capital of S Limited, you will presume it. I will write here share capital of S Limited on the date of acquisition, DOA, 5 lakh. Then I will write here other equity. Other equity. Now could you let me know what was the balance in the other equity of P Limited on the date of acquisition. Other equity on the date of acquisition. Other equity on the date of acquisition. Other equity is given to us as 3 lakhs. Now when you did the analysis, I told you in the beginning, balance in other equity was 1 lakh. So this balance, other equity, 1 lakh will be written over here. That means in the beginning of the year, S Limited was having rupees 1 lakh in other equity. So now you have concluded that on the date of acquisition, 6 lakh was the equity of S Limited, 5 plus 1. I told you earlier, equity can also be found out by subtracting liabilities from asset, but problem is that I cannot adopt that approach here. The reason is that we are having closing balances of assets and liability. How can we find out the balances in the beginning? So that is the reason we have to adopt this approach. So share capital plus other equity is nothing but equity, and equity is nothing but net assets. So that means you have now computed equity on the date of acquisition, and this will play a very significant role later on. Equity on the date of acquisition. So on the date of acquisition, now we may say that equity of subsidiary company was 6 lakh. That means when we acquired the control, total net assets must be equal to 6 lakh, and out of those 6 lakh, because 3/5 share belong to us, we may say 3,60,000 worth of asset belong to us, and 2,40,000 worth of asset belong to other shareholder, that is non-controlling interest holders. Is it clear to you? Now, it is also important for you to write here post acquisition other equity. Post acquisition other equity. That means whatever profits or reserves subsidiary company has earned in the post acquisition period. As we saw here, subsidiary company in the post acquisition period has earned 2 lakh worth of equity. That is why the closing balance is 3 lakh. That means this closing balance comprises of 1 lakh brought forward balance and 2 lakh which subsidiary company has earned during the year. This entire 2 lakh is post acquisition period. So we will write here post acquisition other equity 2 lakh, and out of this 2 lakh, 3/5, 1,20,000 belong to us and 80,000 belong to non-controlling interest holder. Non-controlling interest holder. Is it clear to you or not? Non-controlling interest holder. After having done this much, now the next step is, this standard says, because you have made the investment in the other entity, and even under Ind AS 103 we have seen that whenever we make investment in other entity and acquire the control, we have to compute goodwill. So similar to that, we will have to compute the goodwill. Next step is calculation of goodwill. And remember one thing, goodwill will be computed as per Ind AS 103 only. Calculation of goodwill or gain on bargain purchase. In order to compute the goodwill, what I am going to do, as we did so many questions under what we call Ind AS 103 with respect to goodwill, so same thing you are going to apply here. First of all, you simply write here equity or net assets, because equity or net assets are one and same thing. Equity or net assets of subsidiary company S Limited on the date of acquisition. There is no need to write such a long sentence. You can simply write equity or net assets of subsidiary company. It automatically means on the date of acquisition. You have just computed it. Correct? In the table, we saw that equity on the date of acquisition is equal to 6 lakhs. Correct? Now, out of this, I will subtract NCI share. That means other shareholder share. NCI share. NCI share of equity. Whenever we use the word equity, indirectly means we are referring to net assets. So NCI share of equity or net assets is, we have already computed 2,40,000. So out of 6,240,000 worth of net assets, we may say actually belong to NCI and rest belong to us. So whatever balance is there, this balance reflects P Limited share in equity on the date of acquisition. On the date of acquisition. On the date of acquisition, by investing the amount, you acquire the control. On that date, you got hold of only 3,60,000 worth of net assets. However, how much you paid? Consideration. Now you are going to compare it with consideration. Consideration. What we mean by consideration? Consideration means cost of investment. And what we mean by cost of investment? Cost of investment means amount which the P Limited has churned out of its pocket to acquire 3,000 shares in S Limited. So cost of investment, we have written 10 lakhs, quite heavy cost anyway. So the important point is, as you have seen, we have applied similar rules which we applied under Ind AS 103, correct? That means computation of goodwill is controlled not by Ind AS 110 but rather by Ind AS 103. Anyway, the point here is that we paid much more than what we got. So on the date of control, when we paid 10 lakh, we got hold of only 3,60,000 worth of assets. So quite obviously our investment is more than what we are getting against it. So the difference is capital loss, and this capital loss is considered as goodwill. So this is goodwill. 6,40,000. This is how we are going to compute the amount of goodwill. Is it clear to you or not? After having computed the amount of goodwill, now the next step is, if under this step, what I am going to do, under this step, I am going to write here calculation of NCI on the reporting date. On the reporting date means when you are going to present your consolidated financial statement, obviously at the end of the year. Reporting date means at the end of the year. At the end of your accounting year, when you are going to present your CFS, obviously you will have to represent the NCI share also. That means how much NCI is having what we call stakes in your company. So it is very easy to compute. We know that share of NCI in net assets or equity as at date of acquisition. On the date of acquisition, NCI is commanding control of 2,40,000 worth of net assets. We can say so. And in the current year, equity of this entity has increased. In the current year, this post-acquisition means after acquiring the control, the other equity of subsidiary company has increased by 2 lakh. Out of that increase, something will move in the hands of P Limited and something will move in the hands of NCI. So that means we can say that share of NCI in the post-acquisition other equity is 80,000. So quite obviously their equity now by the end of the year will be different from this one. So I will write here share of NCI in post-acquisition other equity. In post-acquisition other equity, we have seen 80,000 is their share. It means 3,20,000. 3,20,000 will be the amount which I am going to report when I am going to prepare consolidated financial statement. Is it clear to you or not? Now the next step is, once you have found out NCI, the next one is preparation of consolidated financial statement. And this is exactly what we are craving for. consolidated financial statement. Now I will prepare consolidated financial statement. Very simple to prepare consolidated financial statement. No hard and fast rules. First you write here assets. Correct? First I write here assets. Written? Fine. After having written the assets, now the next step is one non-current asset. Non-current asset. In the balance sheet, actually, what I am supposed to do, where I have written the question, let me have a look over that first of all. Here is the question. These are the sheets, lots of sheets actually now. You can see so many sheets I have already filled up. And this was the, this is liabilities. Yes. Here is the original balance sheet. First item is PP. All we have to do is simply do the line by line addition. Only 3 items require a little bit of attention. Financial assets will not appear in the consolidated financial statement. Why? I will let you know. Similarly, share capital of subsidiary company will also not appear when we are going to prepare later on the balance sheet, consolidated balance sheet, and other equity of subsidiary company. Only 3 items you have to take care of, and rest of the items you will have to do simply line by line addition. Correct? For example, when I will prepare the balance sheet, correct? So, parent, I am parent company, my non-current assets are worth rupees 10 lakh. All I am going to do is simply add the subsidiaries company's assets, 5 lakh. Consolidated financial statement means you are preparing the group's financial statement. Correct? So, your group means parent plus subsidiaries. So, your group, it may be said now, is having non-current assets worth rupees 15 lakhs. Is it clear to you? Under the non-current asset, you have written property, plant and equipment. Then financial assets. I just told you financial assets, that is investments. Although I am writing, but it will not be written in the consolidated financial statement. Investments will not be written over here in consolidated financial statement. Reason being is that when we write the goodwill, as I am going to write it, when I am going to write the goodwill, the amount of investment will automatically get adjusted, because ultimately goodwill was computed by comparing the net assets which we acquired with the investment which we made. So that is why investment will not be presented in the consolidated balance sheet. You need to understand that. And because we have computed the goodwill, and goodwill amount was 6,40,000, I think, I have forgotten anyway, whatever it is. So 6,40,000, I am going to write it through our working note, or whatever note it was. You can mention the step. For example, here is step number E, that is 6,40,000, correct? Then I am going to write here current asset, and current assets of P Limited in the question given which I wrote is 6 lakh and 9 lakh. Simply line by line addition, 15 lakhs. So 36,40,000 will be the total of your asset side. 36,40,000. 36,40,000 will be the total of your asset side. Is it clear to you or not? Absolutely clear. Now we can prepare equity and liability side. Equity and liability side. Equity and liability side. As far as equity and liability is concerned, first of all we write equity. I have already told you, under equity we are going to present first of all a share capital. And as I was talking a bit earlier, we are not going to present the share capital of subsidiary company. I am simply going to write in the outer column share capital of parent only. Of parent only. We are not going to write the share capital of subsidiary company. Share capital of subsidiary company 5 lakh we are not going to write. The reason being is that we have already used this particular share capital for the computation of goodwill and NCI. You may wonder how. I will let you know. See here, share capital of subsidiary company was 5 lakh. When we prepared that table, you remember? When we prepared that particular table, I have written 5 lakh here, isn't it? And this got divided between P and NCI, no doubt about that. So that is the reason, that means you have already used the share capital of subsidiary company. So that is the reason capital of subsidiary company will not find place in the what we call balance sheet. And after the equity, we have to write here other equity. And just a moment ago, I also told you other equity of subsidiary company will not be written over here. Now other equity will be presented this way. First of all, we will write here P Limited's other equity. P Limited's other equity balance was, that is the problem. Let me go through the sheets. Other equity balance, where is the question? That is 7 lakh. Other equity balance of P Limited is 7 lakh. You write it as it is, correct? And now you are going to add here share in post-acquisition other equity of S Limited. S Limited has earned some equity in the post-acquisition period, correct? Whatever your share in it is there, that is considered as of revenue nature, and you are going to add that along with your other equity. 2 lakh was the amount in the post-acquisition period and your share was 1 lakh 20. So you are going to write here 1 lakh 20. So 8 lakh 20,000 will be the balance of other equity. Other equity of subsidiary company will not be written. Reason is same, because we have used that for the purpose of computation of goodwill, etc. Because you must have noticed we have taken 1 lakh to the what we call other equity when we computed other equity balance on the date of acquisition, and 2 lakh we have already taken it towards the what we call post acquisition period. So entire 3 lakh is already exhausted, so you cannot write it again. Now the next step is, only 3 things are very important when you prepare the consolidated balance sheet. Investment will not be written, share capital of only the parent will find place, and other equity of subsidiary company will also not find place, and rest of the items simply you will have to do the line by line addition. Besides, in this question we have computed NCI. Remember one thing, NCI through your working notes, whatever your working note was there, we computed non-controlling interest holder 3 lakh 20. Many people do not know how to present NCI. NCI is presented under the equity as a separate line item. That is why I haven't written here CA or something like that. Under equity actually I am writing it, but it is being written as a separate item. Is it clear to you? Then I am going to write here liabilities. As far as liabilities are concerned, non-current liabilities, simple line by line addition is needed. Now non-current liability, parents 4 lakh, correct? And I think subsidiaries was 2 lakh. So total will be equal to 6 lakhs. And then finally the current liability. Current liability, ours was 5 lakh and subsidiaries was 4 lakh. Total is equal to 9 lakh. And if I am going to add it, it will be equal to 36 lakh 40,000. This is all, and these are the steps which we shall have to adopt to prepare the consolidated financial statement. Correct? Of course, we are going to discuss a lot these steps in the upcoming sessions without an iota of doubt. So till then we take bye of you, and when we are going to meet in the next session, quite obviously we will definitely discuss these provisions again. We will do some more questions, and obviously after some time you will feel absolutely at ease with respect to this particular chapter. So in the upcoming session we shall meet you. Till then, it's goodbye from here.